There are different sources through which the company can collect capital or can take cash. For example, the company can take cash through equity share capital, and a company can collect money through preference share capital. A company can collect money through debts, and a company can collect money through the retained earnings. And when we combine all these things, we can calculate the weighted average cost of capital. Weighted average cost of capital. It means to calculate the weighted average cost of capital, we need to collect the individual cost of all these things, all these equity share capital, preference share capital, debts and retained earnings. Okay. Now first we will go through the debts. Debts, the person who buy the debts, they expect the interest from the company, and the interest is the expense which the company has to pay to the debtors at any cost. So that's or we can say the debentures. So, and the company also get the tax benefit on the debt. So there are the question of the before tax and after tax on the debt. So how we can calculate the cost of debt for a company, because when a company is collecting money from the people, they have to pay the interest. So we can divide the cost of the debt into two parts, where we can talk about the perpetual. Perpetual means the irredeemable cost. What do you mean by irredeemable cost? Irredeemable cost means a company don't have to pay the debenture holder during their lifetime, and redeemable debts means the company has to pay to the debenture holders after some time period or at the time of maturity, whatever is fixed by the company and the shareholder. Now how we can go with the irredeemable cost? Now we discussed before discussing the debenture holder that the company has to pay the interest, and there are tax benefit also. It means there are the two types of method where we can talk about the pre-tax and the post-tax. Now cost of what are the methods or what are the formulas which we can use to calculate the cost of debt before tax? Now the first formula for calculating the cost of debt is equal to interest upon principals. Okay, interest on principal, or you can also use the SV, sales value. And when we talk about the cost of debt after tax, we can refer that D, and we can say this as a KB, interest upon SV into 1 minus T. T stands for the tax. So these are the two methods which we can use for calculating the cost of debt in a perpetual method. Perpetual means the company is not going to pay the debenture holder during their lifetime. It means at the time of liquidation, the company has to pay the debenture holder, otherwise they will make the payment of the interest. So how we can solve the practical question? This is only for the cost of when the condition is of a perpetual debt, and the other methods are the different. So first we will go with the cost of debt before tax and after tax in a perpetual method.